7:29 p.m., Claude responded. The S&P 500 dropped nearly 10%. The S&P 500 dropped nearly 10% in weeks. And then, in 13 trading days, it came roaring back, 12.3%. One of the fastest recoveries since 1950. Most people watched that happen and thought, okay, that was scary, but we're back. Everything is fine. And I need you to stop right there. Because the price being back is not the story. The story is what changed underneath while everyone was panicking. And if you missed it, or if you are still confused about what this market is actually doing, stay with me. Because I want to show you the chart, the numbers, the specific stocks, and the one framework that separates the investors who are going to do well over the next few years from the ones who are going to keep getting shaken out every time a headline appears. Let me start with what actually happened. Late February 2026. The Iran war begins. The Strait of Hormuz, a waterway that carries roughly 20% of the world's oil, gets disrupted. And within days, the market starts reacting. Not slowly, 5 straight weeks of losses. The S&P 500 goes from all-time highs to nearly 10% below those highs. Brent crude jumps 44% from pre-war levels and is trading around $105 a barrel by late April. Gasoline in the United States crosses $4 a gallon for the first time since late 2023. The March CPI number comes in at 3.3% year over year, the highest reading since May 2024. The energy index alone jumped 10.9% in a single month. People start saying stagflation. They start saying 1970s. They start saying rate hikes are coming back. And I understand why. Those numbers are real. I am not going to sit here and tell you oil at $105 does not matter. It does. I am not going to tell you CPI at 3.3 is nothing. It is not nothing. These are real pressures, and the fear is real. But here is where most investors stop. They read the number, they feel the fear, and they make a decision. Sell. Rotate into energy. Rotate into defense. Wait for clarity. And that is exactly the move that cost people money this spring. Because while they were doing all of that, the market recovered 12.3% in 13 trading days. Some of them never got back in. Now look at the chart, not the oil chart, the earnings chart. The S&P 500 is currently trading with a forward price-to-earnings ratio of approximately 21. That sounds expensive to some people, but here is what matters. Earnings are expected to grow 17% in 2026 and another 17% in 2027. Wall Street analysts across 21 major banks and research institutions have a median year-end target for the S&P 500 of around 7,650. That implies roughly 8% upside from current levels. And this is with an active war, oil at 105, and a Fed that is not cutting. So the question I want you to sit with is, why is the market near all-time highs during all of this? It is not because investors are naive. It is because the market is not pricing the headline. The market is pricing the earnings. And right now, the earnings picture is not broken. That distinction matters more than almost anything else in this conversation. Let me show you the historical pattern, because this is important. This has happened before, many times. In 2011, the market sold off hard. European debt crisis, downgrade of U.S. credit. Everyone was convinced it was over. The market bottomed in October 2011 and hit a new all-time high by February 2012. In 2018, December specifically, the market dropped sharply on rate fears and trade war concerns. Everyone was convinced it was over. Market bottomed in December 2018, hit new all-time highs by April 2019. And then 2020. COVID. The fastest bear market in history. 34% gone in 5 weeks. Everyone was convinced it was over. Market bottomed in March 2020 and then launched one of the strongest bull markets in modern history. What is the pattern here? The event looks catastrophic in real time. The fear is real. The selling is real. And then, earnings keep growing, businesses keep running, and the market moves back up. Faster than most people expected. Faster than most people could re-enter. The average market correction, a 10 to 20% decline, historically lasts approximately 17 days. 17 days. And here is the specific data point I want you to hold. After the 12.3% 13-day rally we just saw, the one that snapped 5 weeks of losses, Carson Investment Research looked at every similar instance since 1950. Only 9 previous times had the index climbed that much that fast. In 8 out of those 9 cases, the market was higher 12 months later. The median 12-month gain in those 8 cases was 22.6%. That is not a guarantee, but that is not nothing either. The 1990 Gulf War caused an oil shock, a market sell-off, fear of inflation, fear of recession. What happened after? The market recovered and ran for most of the decade. The pattern repeats because the underlying logic repeats. Geopolitical events are painful, but they do not permanently destroy corporate earnings unless a recession follows. And right now, FactSet is not modeling a recession. They are modeling earnings up 17% this year and another 17% next year. Deeper bear markets, 20% plus, historically require either a significant earnings contraction or a genuine recession. Neither is currently in the base case forecast. Now, before you say oil will cause inflation and inflation will cause a recession, listen carefully, because this is where people talk themselves into the worst decision. Go look at the Dallas Fed paper published April 17th. They modeled the actual inflation impact of the Strait of Hormuz disruption. Even under a scenario involving a 15% global oil supply shortfall, which is a serious, severe scenario, the projected impact on headline PCE inflation by the end of 2026 is 0.6 percentage points. Not 6%, 0.6. Long-run inflation expectations in the model barely move. The 10-year inflation expectation impact is almost zero. Yes, the OECD is projecting U.S. inflation at 4.2% for the year. That is above the Fed's target. That is uncomfortable. And the Fed held rates steady at the April meeting. Their words were essentially, "We are watching. We are not moving yet." Jerome Powell's term ends May 15th. Kevin Warsh is nominated to replace him. That transition adds a layer of genuine policy uncertainty, and I am not going to pretend otherwise. If Brent stays above $100 into the third quarter, and the Fed has a new chair trying to prove something, that is a real risk. I want to be honest about that. But here is the contrarian point. The inflation narrative right now is built almost entirely on energy. Strip out energy, and core CPI came in at 2.6% in March, actually below expectations. The inflation is real, but it may not be as structural as the 1970s comparisons suggest. And that matters enormously for how you think about the next 12 months. Now I want to talk about the investors who got this wrong, because understanding the mistake is half the framework. A lot of people sold growth stocks in the first quarter. They rotated into energy, into defense, into cash. Some of them were right for 3 or 4 weeks. The energy names moved. The defense names moved. But then, and this is what the chart shows clearly, the exact stocks they abandoned came back. AI stocks, software stocks, semiconductor stocks. They underperformed in Q1, got sold, and then the 3-week April rally happened before most of those rotated investors could reverse course. According to analysts looking at the recovery, even after that rally, AI stocks and software names had not pushed to valuations that top analysts considered unreasonable, which means the people who rotated out paid a cost. They paid for their fear in the form of missed returns. The market does not wait for you to feel comfortable. That is not pessimism. That is just how the math works. By the time the fear is gone, the price has already moved. So what does the prepared investor do instead? Here is the framework I want you to take away from this video. And I am going to be specific because I am tired of vague advice. First, watch earnings revisions, not just price. The price scared people this spring, but earnings estimates for 2026 and 2027 held up. When earnings estimates are intact, the valuation math changes even if the price stays the same. A stock at 21 times forward earnings growing at 17% annually is a very different animal than a stock at 21 times earnings with zero growth. Same multiple, completely different investment. Second, understand the difference between expensive and overvalued. These words are not synonyms. Expensive is a number. Overvalued is a judgment about whether that number reflects the business underneath. And right now, inside the same AI theme, you have businesses that are expensive and probably not overvalued, and businesses that are expensive and almost certainly overvalued. The chart shows this clearly. Look at Nvidia. Forward price-to-earnings ratio of approximately 24 to 25. Annual revenue of nearly $216 billion in fiscal 2026. Free cash flow of roughly $97 billion per year. Q1 fiscal 2027 guidance of approximately $78 billion in revenue in a single quarter. $97 billion in free cash flow. This is not a concept. This is a machine generating real money, and it is tied directly to every hyperscaler, every AI model, every data center being built right now. Is it expensive? By historical standards, yes. Is it overvalued? That is a harder argument when you see the free cash flow number. Now look at Alphabet. Forward PE of approximately 28. Google Cloud revenue projected to accelerate toward 44% growth in 2026, according to Morgan Stanley. Earnings per share grew 37% in the third quarter of 2025. Advertising business still growing. AI integration accelerating across search and cloud. And you can own it at 28 times forward earnings. For the market, for the AI theme, for the long term, this is arguably the cheapest mega-cap AI business available right now. Not because it is broken, because the price has not caught up to what is happening inside the business. And then there is Palantir. I want to be careful here because I know people have strong opinions. The business is real. Revenue grew nearly 63% in Q3 of 2025. U.S. commercial revenue is expected to exceed $3.14 billion in fiscal 2026, implying growth above 115%. The AIP platform has genuine enterprise traction. The government side is benefiting from accelerating defense budgets. This is not a fake company, but the valuation, somewhere between 116 and 178 times forward earnings, depending on which estimate you use. That valuation prices in perfection, not just good performance. Every quarter, everything right, every estimate hit, no margin for error. That is an extremely high bar. Sorry, let me say that differently. Nvidia at 25 times forward earnings, generating $97 billion in annual free cash flow, is not the same risk profile as a business trading at 170 times forward earnings. The word expensive does not mean the same thing for both. One is a business with a margin of safety built into the cash flow. The other requires you to believe the growth compounds for years without a single meaningful miss. Watch Palantir. Respect what they are building, but do not be reckless with the position size at this valuation. And for the investor who does not want to pick individual names, that is completely valid. The S&P 500, SPY, QQQ, the long-term math on broad index ownership is among the most durable arguments in investing. The index survived 2008. It survived 2020. It survived every oil shock, every rate cycle, every war, every recession of the last 70 years. There is no shame in buying the index, adding to it slowly, and letting compound growth do the work over a decade. If you want the full list of companies I am currently watching, not just the 4 names from this video, but the complete watch list with the business logic behind each one, I have put that together in the free guide below. Download it, go through the reasoning, and use it as a starting point for your own research. Not a signal to buy tomorrow, a starting point. Now let me bring this back to where we started. Because the charts, the numbers, the stocks, that is all useful. But the most important thing in investing is not the list. It is not the ticker. It is the decision you make when the fear is at maximum. That is where the real money is made or lost. The investor who panicked in March 2020 and sold, they missed what came next. The investor who sold in 2011 because Europe looked too risky, they missed the recovery to new highs by February 2012. The investor who sold in late 2018 because of trade wars and rate hikes, they missed new highs by April 2019. And the investor who sold this spring because of oil and inflation and the Iran war, some of them missed 12.3% in 13 days. Not because they were stupid, because they were human. Because the fear felt more real than the data. And that is the trap. Markets will keep doing this. There will be another war after this one, another oil spike, another inflation scare, another thing with a scary name and a scary chart. Powell's replacement will say something markets do not like. An earnings miss from a major company will send a sector down 15% in a day. A geopolitical headline will hit at market open, and the futures will be read before you have had your coffee. This is just what markets do. The investor with a plan does not need the world to be peaceful. They do not need the oil chart to be calm. They do not need the Fed to cooperate. They need the businesses they own to keep earning money. And right now, 17% earnings growth expected this year, another 17% next year. The businesses are, broadly, still earning money. Do not panic. Do not chase what already moved. Do not go all in on one idea. Build the list. Watch the earnings revisions. Own quality where the valuation still makes sense. Buy slowly during fear, not aggressively after the rally. And think longer than the next 3 months. The chart will scare you again. The headline will find something new to be afraid of. That is the game. The question is whether you are playing it emotionally or systematically. Because that choice, made repeatedly over years, is where the real separation happens.